Vocabulary highlighted in the book Warren Buffett's 3 Favorite Books by Pysh, Preston George. 1. Country's largest growth spurt. 2. Financial decisions as a punching bag. 3. Poised and prepped with billions in cash. 4. I'd actually declare Buffett is more reactive than proactive in his investment strategy. 5. The problem compounds when those same people want to make a lot of money quickly. If you're one of those people, you've got the wrong book. 6. The reason most investors can't take advantage of this intuition is a few simple words: emotions, patience, and knowledge. 7. In short, an asset is anything that adds money to your pocket each month instead of taking it away. 8. The 2 most lucrative ways to build assets: owning businesses and providing loans. 9. Mispriced assets. 10. Wealth equation is the firm understanding that stocks and bonds go together like a husband and wife. 11. Chuckling customers. 12. Piggy bank. 13. Flinching. 14. No, $85 is your book value, or the value of your business if you ended it today. The intrinsic value is always worth more than your book value if you have a profitable business. 15. You quickly realize that owning a business involves math. 16. Remember the phrase, "What's it worth?" It's the keystone to becoming wealthy. 17. Stock equals a real business. 18. He always tries to determine what he thinks the company is worth before looking at the price others are willing to sell the company for, the market price. 19. Earnings. This is the net income after receiving funds and paying debts. 20. Market price. This is what people in the market are currently willing to buy and sell a stock for. 21. Book value. This is the value of the business if it stopped production or work right now. 22. Intrinsic value. This is the value smart investors calculate the business to be worth. 23. Billy, the market price is what you'd be willing to sell the business for right now. 24. Blurt it out. 25. So, what's the catch? 26. Kids were willing to become partners in what they perceived as a good thing and a good deal. 27. It's a great company? When I hear people say that phrase in reference to their investment strategy, I almost start convulsing. That phrase is the hallmark of a person destined to lose money in the stock market. 28. Shares outstanding. This is the number of shares that a company is divided into. 29. At the end of the tally. 30. He was fuming. 31. As if rubbing salt in the wound. 32. First, I'll talk about the idea of financial relativity. I would argue this concept is one of the major reasons people lack the patience to accumulate assets. 33. Point is, investors should always consider the growth of their assets in relative terms. 34. Teaching patience is a difficult task. 35. Buying stock in a great company doesn't mean you'll make a profit. 36. The success of a stock pick heavily relies on the purchase price as much as the productivity of the already successful business. 37. EPS, earnings per share. 38. Price to earnings ratio, P/E ratio. 39. This is everyone's favorite ratio. 40. Ensure you only replace the $1.16 with the company's P/E when you read the above sentence. The $1 in earnings at the end of the sentence never changes. 41. For every $15.05 I spend buying this company, I can expect $1 in earnings a year later. 42. As you can see, the higher the P/E goes, the worse the sentence sounds. 43. The yield is the percent that's paid to the owner based on the current market price. 44. That's an enormous dividend, and you'll never see that in real stock trading. I typically like to see a 3% or greater dividend in a stable market. 45. Be sure to really study these terms and understand them. 46. The first thing you need to understand is a bond is a loan. 47. The bond is an agreement that specifies when and how the organization or person will give you your money back with interest. 48. Hodgepodge. 49. George told his son that most coupons are paid to the bondholder twice a year. 50. Purchasing a bond is nothing more than a way for you to loan money to a company or government. 51. Purchasing a bond equals providing a loan. 52. Sternly replied. 53. As the next school of fish passed. 54. These three words are why informed investors can make money in the stock and bond markets. 55. As a result, you would follow the crowd's lead. 56. How many times in financial markets do investors sell their shares because they are scared of the unknown? Often. 57. They move when others move. 58. Fish and start identifying the rocks being thrown in the water. 59. Equally important, let's examine the fear instinct. 60. As you can see, the instinct of fear determined the children's decision to sell their profitable business, not value. 61. For informed investors, fear and greed cycles are enormous opportunities. 62. During fear cycles, recessions, these are the least risky and most profitable times for purchasing stock. 63. During greed cycles, bull markets, these are the most risky and least profitable times for purchasing stocks. 64. During fear cycles, recessions, these are the most risky and least profitable times for purchasing bonds. 65. During greed cycles, bull markets, these are the least risky and most profitable times for purchasing bonds. 66. Wealthy investors always understand the intrinsic value of their investments. 67. Be fearful when others are greedy, and greedy when others are fearful. 68. Market price is never equal to intrinsic value. 69. I think everyone can agree the savings bond is a much better deal because it has no risk. 70. Your job is to find the quality companies, like Billy's Lemonade Stand, that are selling for $1 and not $20. 71. Great investors always think for themselves. Never let the opinions of the masses sway the calculative value you place on your investments. 72. You see, Billy, right now, people are fearful. As a result, I'm reacting to that fear and I'm selling my conservative fixed income securities, or bonds. 73. Unfortunately, the poor are becoming poorer. Your future ability to react to the conditions will soon determine your fate. 74. But I knew they were overvalued. 75. As a result, bonds were actually a better investment despite the opinions of most people. 76. See the gerbils running. 77. You simply compare your expected return of a stock to the expected return of a long-term bond. 78. There are plenty of investors who have consistently made millions through patience and a conservative strategy. The only way you'll ever know is to start with the basics and teach yourself. 79. Unfortunately, not everything with stock investing is intuitive. 80. I had beat into my head. 81. By forcing us to teach ourselves, and often take tests before learning lessons, we learned how to take the initiative and learn on our own. 82. You, as a calm, clear-headed, and logical investor, have an advantage over the rest of the market. 83. Understand, the market doesn't really produce anything. It is a medium for the exchange of wealth. 84. Thus, ultimately, the average investor does make money. However, responsible and disciplined methods can increase those returns substantially. 85. The author of this book contends that the standard for investing, specifically, long-term, should be taken from a readily available risk-free investment. 86. If you can make 2.125% without risk, clearly, no investment that involves risk should have a lesser rate of return. 87. Why accept risk for a rate of return that can be attained without risk? 88. We determined that no security should return less than the return of an investment with zero risk, Treasury note. 89. Initial value of your savings, also known as principal. 90. I won't consider an investment unless I think it'll return at least 1.75 times the rate of return I'd expect from a zero-risk investment. 91. One important thing to keep in mind is that if an investment is considered high risk, it's not an investment. It's a gamble. 92. The wise investor will never fall for the high-risk, high-gain trap. 93. A bond is nothing more than a loan. When a company or government wants to raise money, it has the option to issue a bond in order to raise capital. 94. The piece of paper was a debt obligation owed to the holder. 95. You'll quickly find that a few things have an impact on the value of that bond: interest rates, inflation, and the financial health of the issuer. 96. Adjust interest rates as it deems necessary. 97. The reason the Federal Reserve lowers interest rates is because it wants to spark spending in the economy. 98. One thing I think everyone can agree on is that the leaders of the Federal Reserve absolutely understand macroeconomics. They know that if the stock market and the U.S. economy are growing too quickly, it will lead to a financial bubble. 99. Since newly issued bonds are only yielding 4% and you've got the 5% bond, you can now sell your security for a premium. 100. When interest rates rise, your bond values decrease. When interest rates decrease, your bond values increase. 101. Will demonstrate the importance of never buying a low-coupon, long-term bond. 102. It becomes clear how bond investors make their money. They buy high-coupon bonds when interest rates are high. 103. There's one thing that's for sure: the U.S. government likes to spend money. 104. The U.S. government has two ways to pay for that spending. The first is obvious: taxes. The second is sneaky: inflation. 105. Inflation occurs because the federal government prints additional money from thin air. 106. In simple terms, inflation is nothing more than an acid that eats away at the value of a bond or loan. 107. When you're calculating the value of your investment, always be sure to assess the impact that inflation will have on a bond. 108. Cost. In the end, the customer is the person who's affected by the inflation, not the viable business. 109. Graham simply emphasizes that inflation doesn't have a positive or negative impact on the value of a stock. 110. If inflation is something you're genuinely worried about, which is a plausible concern, investing in a TIPS bond is a great decision. 111. The reason the loan officer wants to know is because he doesn't want you to default on the loan. 112. The feds will always have the ability to make their payments. 113. Since these governments don't print their own money, they have the capacity to actually go bankrupt, and some of them do. 114. At the end of the day, never purchase a municipal or corporate bond without knowing the financial health of the issuer. 115. As you probably already know, the yield of a bond is directly related to the length of borrowing. 116. As an investor, when you really begin to study yield curves, you'll begin to realize the importance they play. They're a great tool to generally determine over- and undervalued markets. 117. As a general rule of thumb, the average 30-year federal bond yields 5.4%. 118. In fact, much of the math that's associated with solving bond values is fairly complex and difficult to understand. 119. When purchasing a bond at a high interest rate, I can't wait for the day to sell the bond when interest rates crash. 120. The most important thing to understand is that non-federal bonds have the ability to fail. 121. From an individual investor's standpoint, the amount of risk associated with stepping into non-investment grade bonds is beyond my appetite for risk. 122. During times of greed, when people are making enormous amounts of money in the stock market, you need to be thinking the opposite. You need to be potentially purchasing an armory of bonds. 123. Since the math progressively builds upon itself, it's important to never skip a section you don't understand. 124. 1. A stock must be managed by vigilant leaders. 2. A stock must have long-term prospects. 3. A stock must be stable and understandable. 4. A stock must be undervalued. 125. Warren Buffett is on the record for saying is that he always calculates the intrinsic value of a company before he looks at the trading price. 126. Strongly encourage investors to research the CEO and board of directors for any stock pick they potentially want to invest. 127. A CEO who puts the interests of his employees before himself, through employee benefits and such. The composition of the board of directors. A CEO who has a track record of conducting ethical business. A CEO who doesn't get paid outrageous compensations. 128. Vigilant leadership is management that's always on the lookout for possible danger. 129. If a company even possesses a hint of mismanaged debt, I'll immediately stop considering the pick. 130. There are too many great companies on the market with zero debt compared to businesses with similar products that carry a lot of leverage. 131. But when you're dealing with billion-dollar corporations, debt makes the cards crumble during a recession. 132. As you become more comfortable with investing, you'll find some sectors inherently carry more debt than others. 133. But the primary version you need to understand is total debt divided by the company's equity. 134. Equity is essentially what the company is worth, right now, if it sold everything and paid all its bills. 135. As you can quickly see, a low debt/equity ratio is a good thing. 136. For me, that's a scary amount of debt and not something I want to take a chance on. 137. As a general rule of thumb, I try to always buy companies that have a debt/equity ratio below 0.50. 138. Current ratio. This ratio is a comparison of the current assets divided by the current liabilities. 139. You'll understand that a company reports its assets and liabilities every quarter for tax purposes. 140. By dividing the short-term assets by the short-term liabilities, we'll quickly be able to determine if the company will be able to pay its bills for the next. 141. When I'm analyzing a business, I'll never consider a business that has a current ratio below a 1.0. 142. A third way to evaluate a company's fiscal responsibility is to review the rating on its bonds. 143. Just like you have a credit score, companies receive similar scores on the bonds. 144. Although this is a quick and easy way to estimate the health, I still prefer to look at the D/E and current ratio first. 145. It should come as no surprise that a business that maintains low levels of debt will weather bad economies well. Poorly managed debt will result in enormous market swings and years of slow growth during and following recessions. 146. One of the most fundamental concepts of making money in the stock market is buying a company that you can hold forever. 147. You don't want your business to eventually turn sour. 148. You don't need a crystal ball to predict the direction of certain markets. 149. That doesn't mean it's not a great business, it just means it's something you need to be willing to accept the risk for. 150. The importance of finding a company that will produce stable returns forever is a smart investor's effort in avoiding taxes. 151. This concept is called unrealized gains. When a person like Warren Buffett touts that he pays less taxes than his employees, this is how he does. 152. He plans on owning the companies longer than his lifetime. As a result, he never pays capital gains on the stock's equity growth, which materializes through the growing market value. 153. The only time you pay capital gains is when you sell the stock. 154. Understanding this important rule is the difference between amateur investors and intelligent investors. 155. A stock must be stable and understandable. 156. One of the most basic tenets in valuing stocks is stability. 157. Based on Mike's past performance, what do you suppose he might receive in each subject for his 12th grade year? 158. You'll find a lot of investors are attracted to companies like Mike, companies that are volatile. 159. You must also understand that most investors lack patience. 160. It is a value-based approach, one in which an investor looks at a predictable company with respect to past performance and assesses its intrinsic value. 161. Without being able to predict reasonable performance into the future, calculating this value is impossible. 162. Intrinsic value can be defined simply: it is the discounted value of the cash that can be taken out of a business during its remaining life. Warren Buffett. 163. The calculation of intrinsic value, is not so simple. 164. Two people looking at the same set of facts will almost inevitably come up with at least slightly different intrinsic value figures. 165. We are only going 10 years into the future because we'll then discount that cash flow by the current 10-year federal note interest rate. 166. As you can see, a business has two options for handling its earnings. A company can invest the money back into the business or it can pay a dividend. 167. A company like Apple only takes option 1. 168. As a result, the only way you'll make money owning Apple is if the equity of the business continually increases. 169. As an intelligent investor, you'll want to find a company that does both. 170. If you died today, how much money would you leave your family? 171. In the above scenario, we can tell immediately whether the generic person mentioned is worth a dime or not. 172. What this company would be worth if it ended its operations today. 173. Just as you calculated your own equity, businesses do the exact same thing every quarter, or every 3 months. 174. The balance sheet is an important document because it shows the current equity of a business at a certain point in time. 175. This equity is a starting point to understanding what the business is worth. 176. I highly recommend buying a book that focuses completely on understanding corporate finance statements. 177. This term simply means equity per share. It's important to put everything in terms of one share because you want to always compare like terms. 178. One of my pet peeves is when I hear a person talk in random terms. 179. When a person talks in unlike terms, meaning he uses figures that reference the business as a whole and then references the business as an individual stock, it immediately tells me he doesn't know what he's doing. 180. When someone says book value, he is really saying equity per share. 181. So, when we take the company's total equity and divide by the total number of shares outstanding, we get the book value, or equity per share. 182. We know that if the company ended today, liquidated, it should be worth the amount of book value. 183. In a simple world, people might think the company should trade on the stock market for the book value. This definitely is not the case. 184. If this isn't the number you found, or you're just having trouble calculating the book value, I highly encourage you not to move forward with the reading. 185. One of the most important figures for an investor to understand is the consistency and amount of change associated with a company's book value. 186. You'll also notice that J&J's book value, or equity per share, is growing almost every year. That is what you're looking for. 187. This chart serves as a great example of finding a company that has steady and calculable growth. 188. After looking at the annual book value, or equity per share, growth over a long period of time, it becomes very important to estimate what % the book value is growing annually. 189. If you look at the change in book value, you'll be able to quickly determine the direction and speed of growth associated with any business. 190. Both numbers will get you in the ballpark. 191. I like to find the difference between every year so I can see if the numbers are relatively consistent. 192. Note, it is very important to always calculate this number using the book value and not the total equity found at the bottom of a balance sheet. 193. Since we are using the numbers as an estimate for predicting future cash flows, either technique will work for a stable company. 194. Now don't forget, this company's book value is growing because of one figure, the earnings. 195. Always ensure the earnings will remain the same or increase in the near-term forecast. 196. If the earnings are decreasing, so will your book value growth and dividends. 197. The earnings are consistent with what we have seen in the past. 198. The second part to determining the future cash flows is summing the expected dividend payments you'll receive over the next 10 years. 199. The income statement is a form that businesses use in order to report the money it makes from the sale of its products and services. 200. Just like how we turned equity into a smaller and more desirable term, book value, we'll do the same thing with net income. 201. $3 of earnings per share. pay a portion of the earnings to the shareholder, known as a dividend, or retain the money as equity. Therefore, the $25.60 of book value would increase. Like I said earlier, find a business that does both. 202. One of the advantages of working for a good company is the ability to get stock benefits. 203. It's not too much and it's not crumbs. 204. Believe it or not, I see companies on the open market paying their owners dividends that exceed the EPS. 205. It doesn't make sense, and I would strongly encourage you to avoid companies that slowly devour themselves in an effort to keep their shareholders happy. 206. The calculation of intrinsic value is not so simple. As our definition suggests, intrinsic value is an estimate rather than a precise figure, and it is additionally an estimate that must be changed if interest rates move or forecasts of future cash flows are revised. 206. That is one reason we never give you our estimates of intrinsic value. Warren Buffett. 207. Intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of a business during its remaining life. Warren Buffett. 208. Do you assume some risk and purchase Johnson & Johnson and potentially receive a 3.59% return for the next 10 years? So this is where your appetite for risk plays an enormous role in your decisions as an investor. 209. This is where I can no longer help you. This risk is something that you'll have to determine for yourself. 210. As you can see, the 10-year federal note is nothing more than a baseline value that we can use to relatively compare all investments. 211. This is one of the reasons stability is so important when analyzing a company's potential to earn in the future. 212. You'll note my investment decisions are completely based on relative factors. Since the market is constantly changing, you'll need to conduct this assessment anytime you wish to purchase a security. 213. The important part isn't tracking the day-to-day changes. The important part is assessing the best priced asset for any time you have cash to invest. 214. Instead of playing the market like a professional Las Vegas gambler, you're now employed with the techniques of a patient and informed investor, like Warren Buffett or Benjamin Graham. 215. As you can see, these calculations mean absolutely nothing if the business isn't stable. Trying to calculate the value of an emerging business is a waste of my time and is speculative. 216. Investing is when you don't know what could go wrong. Speculation is when you know exactly what could go wrong. 217. Say that because the company has volatile numbers that are not only hard to predict, but I'd say impossible to predict. 218. Johnson & Johnson has maintained steady, consistent, positive earnings for the last 10 years. 219. As a result, I'm fairly confident I'll be able to predict its earnings 10 years from now. 220. Without going any further into the analysis, you can quickly see that the company's numbers don't even make logical sense. 221. As soon as companies like Siri miss their earnings expectation, day traders quickly undersell the previous trading price and there goes your money. 222. Blunder. 223. They might be surprised to know that preferred stock is more like bonds. 224. During a corporate bankruptcy, a company would most likely have negative equity. As a result, the investors, listed above, would receive their portion of the assets in the order listed above. 225. The important part to note is that a preferred share is valued just like a bond. 226. As one might expect, preferred shareholders will always receive their dividends before common shareholders. 227. You'll definitely want to understand the company's ability to complete its dividends as a preferred shareholder. 228. Emphasize the importance of savings and cash flow regardless of your annual income. 229. The problem most people have is the discipline to live within their means and stay there. 230. How much of that money do you then use to invest in an asset that's going to put more money in your pocket the following month? If you said none, that's fine. That's why you're reading this book and learning how to fix your strategy. 231. This is important. You need to buy assets that will put more money in your pocket every month. 232. Simple. You need to figure out how much money you can afford to save, long term, like forever, each month without affecting your day-to-day life. 233. When I say save it forever, I mean forever. You want new car money, put it in a different savings account. 234. Increasing your cash flow every month is a key pillar to investing like Warren Buffett. 235. One of the things Warren Buffett is most famous for is being frugal with his money. Now I'm not saying that's a good thing, but I am saying you need to live within your means. 236. You're going to spend money on a liability, i.e., a new car. You want to be sure it's not disrupting your ability to continually grow your assets. 237. If you're not taking steps to purchase new assets each month, you'll never improve your current standard of living. 238. Operating activities. This is all the activity that involves earning money. Investing activities. This is all the activity that involves buying or selling assets. Financing activities. This is all the activity that involves acquiring debt or paying it off. 239. A company that has a solid cash flow statement is a company that can make moves on markets that are undervalued. 240. I know this might sound completely counterintuitive, but the name of the game is really trying to find an asset that you never need to sell. 241. Think you can agree that when shares are simply purchased and sold on emotions, it goes against sound judgment. 242. In the end, they simply want to avoid paying taxes on the increasing value of their shares from year to year. 243. If this is the case, the decision to sell needs to be strategic and not emotional. 244. Always tell yourself that it's your company. Think like an owner and you'll act like an owner. 245. In your real picks, make sure you're always buying dividend companies. 246. I'll say that no one should hold onto companies that have poor fundamentals and change their direction in a way you don't agree with. 247. The capital gains calculation becomes very important when conducting the comparison of two different assets. 248. As you can see, the decision to switch assets shouldn't be guesswork. 249. The company changes its fundamentals and it doesn't correspond with your values and direction. A great example of this is a change in leadership, increased debt loads, a substantial decrease in earnings capabilities, etc. 250. Mathematically, you have calculated that you can make more money in another asset with the same amount of risk after paying capital gains. 251. If Jill were a company, that would be an outstanding ROE. It's been my personal preference to invest in companies that consistently have an ROE over 7%. 252. The reason this number is so important is because equity and intrinsic value are closely related. 253. Assuming Jill were a business, I think we can all agree that if we had to invest in Jill now, we wouldn't expect much of a return on our investment. 254. As we examine the importance of the ROE from a perspective that makes sense, it becomes obvious why this is one of Warren Buffett's favorite statistics to examine. 255. If we were to understand why she didn't sustain her ROE, we could most likely attribute it to her inability to manage her debt and her ability to acquire more assets. 256. In the end, I often find small businesses start with a great ROE, but over time, it declines rapidly as they become a mid-cap and large-cap business. 257. This is something really important to consider when buying your stocks. I personally like to purchase mid-cap and large. 258. But how will they handle the transition when they need to do more than their current focus in order to sustain equity growth? 259. I'd argue there's a lot less risk in maintaining your estimated growth with large ones. 260. The market price is determined by the price that buyers and sellers are willing to exchange. 261. In fact, less than 1% of the owners generally determine the trading price. 262. The number of shares that change owners is called the volume. 263. Remember, these are the very few people who are actually determining the market price of your company, not the value. 264. GE's volume was 44 million shares. This means 44 million shares were sold and bought in one day. 265. This little scenario is a great example of how investors need to always remain skeptical of any market price. To think that only 4 owners of the 1,000 would determine the total value of the business is actually amusing. 266. As a result of the really low price, the volume of trades began to increase. 267. An increase in volume means the traders believe there's a discrepancy between price and value. 268. When you see volume hit really high numbers, you can expect a peak or a valley on the market price. 269. As I'm sure you might have deduced, investing in individual picks might be too confusing and difficult to enjoy. 270. In order to have an expert invest their money, many people use mutual funds. 271. Investors give fund managers money at the wrong time. 272. Now that you've had some time to read this book and understand the importance of buying stocks during fear cycles and holding during greed cycles, this first indicator should make sense. 273. This reason alone severely handicaps fund managers as they attempt to beat the market. 274. Warren Buffett's primary reason for never running a mutual fund is based on the reason highlighted above. 275. Buffett never wanted to be handicapped by uninformed investors. 276. Nesting his stock picks inside the corporation allowed him to take advantage of the fearful and ignore the greedy. 277. Fund managers suck the blood out of your investments with fees. 278. That's a $60,617 difference. Are you comfortable paying your financial advisor 20% of your initial investment? Essentially, that's what you're doing in this scenario. 279. As you can see, the compound interest of your mutual fund fees will have a devastating impact on your investments. 280. For fund managers, lack of movement means they aren't doing anything. 281. If you ask me, the buying and selling that is highlighted in each quarterly report is nothing more than propaganda for the manager's expertise you pay an enormous premium for every year. 282. The primary differences between the two instruments are a lack of fees, a lack of changing assets, and a lack of management. 283. An index is an unmanaged conglomeration of securities that represent a certain segment of the market. 284. The beauty of the index is that the fees are low, under 5%, and underperforming companies are automatically removed when competing businesses perform better. 285. Since different sectors of the stock market experience growth and recessions at different times, index funds offer a minimal amount of risk for entry into a depressed market. 286. Regardless of your investment approach, I'm a huge supporter of index funds. I feel the minimal fees and proven track records make for better investments than mutual funds. 287. Not surprisingly, my wife even started to snicker as I began to talk. 288. Price of a thin G. 289. Many consider Adam Smith to be the founder of capitalism, but I'd argue he probably wouldn't appreciate that title. 290. What he found was when individuals observe and understand not only themselves but others, they become aware of the morality of their own behavior. 291. In Smith's book, he starts by identifying money as nothing more than work or labor. 292. In the end, he produced one of the most comprehensive books ever written on macroeconomics. 293. An investment must be managed by vigilant leaders. An investment must have long-term prospects. An investment must be stable and understandable. An investment must be undervalued. 294. This number is really important because it tells you how much money your single share will make every year. 295. P/E. This is everyone's favorite. It's commonly referred to as the PE. 296. As a rule of thumb, Warren Buffett typically likes to find companies with a P/E lower than 15. 297. Remember, when the volume is really high, it typically means the market price is reaching a high or low. 298. As a rule of thumb, Warren Buffett always tries to buy companies that pay a dividend. 299. This number is very important because it represents the value of the company if it closed its doors and stopped doing business. 300. As a rule of thumb, a company's book value should increase by at least 7% every year. 301. believe the market was absolutely overvaluing the company for the first 7 or so years. To pay a premium of almost 7 times higher than a company's equity usually never makes sense if you want to minimize your margin of safety. 302. As a simple rule of thumb, Warren Buffett typically looks for companies that possess a price/book ratio between 6 and 1.5. 303. Although this little formula is still pertinent, I recommend using the Google Stock Screener. 304. The best way to review the growth is by analyzing the book value/share every year. 305. As mentioned earlier, you'll want to invest in companies that show consistent growth in book value. 306. As a rule of thumb, you'll want to find a company that consistently has an ROE above 10%. 307. Personal favorites is the current ratio. I often use this ratio to determine the financial health of a company. 308. Stock must be managed by ethical and conservative with respect to debt leaders. 309. As a result, this ratio gives potential investors great insight into the short-term outlook of the company. 310. This is a great number. If the ratio was 1.0, then we would know the assets and liabilities are projected to equal each other. If the ratio was below 1.0, then the company would need to incur debt in order to continue business. 311. As a conservative investor, you want to ensure the current ratio is higher than a 1.5. 312. The only way you'll become comfortable learning these numbers is to look at companies that interest you, then start analyzing the numbers. 313. The only problem was I invested on emotion as opposed to value. 314. There are 4 rules to investing. 315. Financial markets move on emotion in the short term but follow value in the long term. 316. Remember, intelligent investors possess patience, knowledge, and discipline.